Silver is sitting at 86.45 right now, flat, quiet, almost boring if you just glance at the chart. But what is happening in Geneva tonight is not boring. And by the time this session ends, in a matter of hours, silver is going to move. Hard. Either direction. And I am going to show you exactly why, exactly what the two scenarios look like in price terms, and exactly what the silver market has already priced in before a single headline drops. This is not a geopolitics video. This is a silver structure video. The Geneva talks are simply the trigger sitting on top of a spring that was already compressed before today's session started. When a compressed spring gets a catalyst, it does not matter which direction it releases. The move is violent either way. Let's build the picture from the ground up. Section 1. The spring was already loaded before Geneva. Before we get to what is happening in Switzerland tonight, you need to understand the structure silver walked into this session with, because the Geneva outcome does not happen in a vacuum. It lands on top of a market that is already under significant strain. Here is where silver stands as of right now, February 26th. Silver is at 86.45. It hit an all-time high of 121.64 on January 29th. That is a 29% correction in under 4 weeks. The official story for that correction: speculative excess, Chinese traders, Fed commentary. We covered that in the last breakdown, but here is what did not correct with the price. COMEX registered silver, the physical metal actually available for delivery, is sitting at approximately 88 million ounces, down from 167 million in October, a 47% collapse in 4 months. That number did not recover when the price dropped. It kept falling. Shanghai silver maintains a $26 premium over Western spot right now. At 8600 Western spot, Shanghai is pricing physical silver at $112. That premium did not close when Western price fell. It widened. COMEX March open interest represents roughly 5 paper claims for every 1 registered ounce. First notice day is tomorrow, February 27th. The delivery pressure clock is already running. Silver RSI has stabilized above 50. The 50-day simple moving average is acting as support. A sustained move above 92.75 would confirm bullish continuation. 85.93 is the critical support level on the downside. That is the structure. Compressed. Loaded. Under physical stress from multiple directions simultaneously. And tonight, Geneva drops a catalyst directly on top of it. Section 2. What is actually happening in Geneva tonight? Let me give you the facts you can verify. Not the narrative, the structure of what is on the table. This is the third round of nuclear talks. The first was held on February 6th. The second on February 17th. Tonight is round 3. Same city, higher stakes. The U.S. delegation is led by Steve Witkoff and Jared Kushner. The talks are indirect. The two sides relay proposals through Oman's Foreign Minister Badr al-Busaidi as mediator. 3 hours of talks happened this morning, then a break. Al-Busaidi said negotiators were exchanging creative and positive ideas. Talks resume tonight around 10 p.m. Here's what is on the table and why it connects directly to silver. U.S. demand: Iran permanently dismantles its nuclear enrichment capabilities. Perpetual restriction: no enrichment, ever. Iran's counter: suspend enrichment for 7 years, then join a regional consortium for low-level civilian enrichment. Freeze now, resume later. That is not a small gap. That is a fundamental disagreement about sovereignty that 3 rounds of indirect talks have not resolved. And on the same day the talks started, the U.S. announced new sanctions on vessels linked to Iran's oil trade. Active diplomacy and active sanctions, simultaneously. And here is the piece the mainstream is completely missing. Iran temporarily closed the Strait of Hormuz for military drills in February 2026. 1/5 of global seaborne oil moves through that strait. They closed it as a signal during active diplomatic negotiations. That is not a country that believes this deal is getting done tonight. Section 3, the 2 scenarios. What silver does in each one. I always give you both sides. Anyone who tells you they know exactly what happens in a negotiation room in Geneva tonight is lying to you. What we can do is map the 2 outcomes and the silver price response to each. Scenario 1, deal progress. Talks resume. Kushner and Witkoff return to Trump with a framework. Iran agrees to cap enrichment and allow inspection access. The U.S. pauses new sanctions. No deal signed. But the war clock stops ticking. What does silver do? Short term, it sells off. Risk-off premium gets unwound. Safe haven flows that have been building since the military buildup began start reversing. Silver gives back $3 to $5 in the session following a diplomatic headline. From $86, that puts you at $81 to $83. But, and this is critical, a $5 diplomatic sell-off lands on top of 88 million ounces of COMEX registered silver, a $26 Shanghai premium, 800 million ounce cumulative deficit, and March 1st notice day tomorrow. The physical floor does not move because a hand was shaken in Geneva. What you get is a buying opportunity sitting on top of structural fundamentals that have not changed. Scenario 2, talks collapse. The gap between permanent dismantlement and 7-year freeze cannot be bridged. Aragchi returns to Tehran without a framework. Trump's war deadline, issued February 20th, runs out with nothing to show. What does silver do? The geopolitical risk premium, partially in the price already, gets fully repriced overnight. Silver has jumped over 20% in the last 6 trading days, partly on this exact risk. A full breakdown adds the remaining unpriced premium on top. The previous pattern from this cycle, when Iran military tension headlines hit at the start of this buildup, silver moved $5 to $8 in a single session. A definitive diplomatic breakdown tonight, with the U.S. military flotilla already positioned in the Middle East, would be a sharper catalyst than any previous headline in this cycle. A $10 move from $86 tests $96 overnight. 92.75 is the technical confirmation level. Break that, and the next target is $95 to $97. 2 outcomes. Both are silver catalysts. The difference is direction and timing. Section 4, the Strait of Hormuz. The connection nobody is making. Let me slow down here because this is the link that mainstream financial media is completely missing. Iran closed the Strait of Hormuz for military drills in February 2026. That is not normal. That is a country signaling that if diplomacy fails, it has the ability and the willingness to disrupt the most important maritime corridor on the planet. Everyone knows about the oil connection. Here's the silver connection nobody is talking about. 50% of annual silver demand comes from industrial applications. Those applications sit inside a global manufacturing supply chain that runs on energy. When oil supply risk spikes, energy costs spike. When energy costs spike, manufacturing margins compress. When manufacturing margins compress, the flight to hard assets, including silver, accelerates simultaneously. Then there is the second layer. A military strike on Iran would not be a limited event. Axios reported this week that any conflict would be a broader, weeks-long campaign. U.S. and Israeli forces are coordinating. The military buildup is not a bluff. It is a staging. In that scenario, the geopolitical risk premium in silver does not add $5 or $10 in isolation. It compounds. It lands on top of a 67 million ounce structural deficit, on top of COMEX vaults at all-time lows, on top of a 26th Shanghai premium that is already structurally locked in by China's export restrictions. Look at what happened to silver in the last major escalation cycle in this series. The metal moved from the high 70s to $121 in weeks. That move was deficit-driven, safe haven-driven, Shanghai premium-driven, all 3 at once. A military escalation scenario tonight does not create those conditions from scratch. It accelerates conditions that are already fully in place. The Strait of Hormuz closure drill was not random noise. It was Iran telling the market exactly what card it holds if Geneva fails tonight. Section 5, the risk premium. Silver has already priced. And what is still missing here is a number worth thinking about carefully. Silver has surged over 20% in the last 6 trading days, from the low 70s to $86. That move happened before tonight's session, before the talks resumed, before any outcome was known. That means the market has already partially priced in Iran risk, not fully. Here's how I know. If the market had fully priced a war scenario, silver would not be at $86. It would be testing $100. The $121 high in January was achieved with structural deficit pressure, COMEX delivery stress, Shanghai premium, and momentum combining simultaneously. Tonight adds a geopolitical layer on top of a market that has partially rebuilt that premium after the January correction, but has not completed the rebuild. Financial Analysis, published this week, described a Geneva stalemate that has created a persistent risk premium in the metals market. The key word is persistent, not spike. The baseline is already supportive. The spike comes if the stalemate breaks. A deal removes the premium and hands you a structural buying dip. A collapse adds the remaining unpriced war premium to a market that is already physically tight. Either way, the direction tonight determines which move silver makes first. The structural case determines where it ends up regardless. Section 6, the technical picture going into tonight. Let's put the chart structure on top of everything we just covered. Silver today, 86.45, critical downside support, 85.93, 50-day SMA, acting as current support. RSI, stabilized above 50, mild bullish bias. Key resistance, 92.75. This is the confirmation level for bullish continuation. Next target above resistance, $95 to $97. Secondary target, $100 psychological level. On the downside would be if diplomatic progress triggers safe haven unwinding, $83 to $81 is the first zone. $78 is the next meaningful support below that. Now overlay the Geneva catalyst. A diplomatic breakthrough does not break 85.93 if physical fundamentals hold. The floor is structural, not sentiment-driven. A paper sell-off into a market with 88 million ounces of registered silver and 5 paper claims per ounce is a dip against a structural floor, not a trend reversal. A diplomatic collapse breaks 92.75 to the upside and targets 95 to 97 in the first move. The second move, if military escalation follows over the coming days, reaches for $100 and potentially back toward the January high zone. The asymmetry here is the key point. The downside from a deal is bounded by physical reality. You cannot sustain a silver sell-off when COMEX has 88 million ounces and 5 paper claims per ounce with March 1st notice day tomorrow. The upside from a breakdown is not bounded by the same floor. Geopolitical premium in a physically tight market does not have a natural ceiling. Section 7. What to watch tonight. All of it is free. I sell nothing. No memberships. No Discord. No signal groups. If you see my name on a paid service, that is a scam. You find me here and on X. Data drops on X when it breaks. Here is exactly what to watch. Every single item on this list is public and free. Watch the Omani Foreign Minister's X account. Badr al-Busaidi posts official statements after each session. When talks resume, his account will be the first public signal of progress or breakdown before any mainstream outlet publishes their version. Watch Silver Spot XAG-E-USD. The immediate price reaction to a Geneva headline hits the spot chart before most analysis is published. A sharp move above $89 to $90 overnight means the market is pricing breakdown risk accelerating. A drop below $85.93 means diplomatic progress is unwinding the premium. Watch COMEX registered silver tomorrow morning. March 1st notice day is tomorrow, February 27th. The delivery demands coming in overnight will update registered inventory. If registered silver drops below 85 million ounces while a Geneva breakdown headline is running, that is the two catalyst convergence point this market has been building toward since October. Watch the Shanghai premium. If the session collapses and Shanghai opens with a premium widening past $30, Asia has repriced faster than the Western paper market has caught up. That is your signal that physical demand is running ahead of the screen price. Watch oil. Silver and oil are not the same asset, but the Strait of Hormuz signal means military escalation moves oil first, and silver follows within hours as the full geopolitical risk premium rebuilds in the precious metals complex. Section 8. The honest conclusion. Here is the full picture tonight, February 26th, 2026. Silver at $86.45, down 29% from January 29th all-time high. Geneva talks resuming tonight. U.S. demanding permanent dismantlement. Iran offering 7-year freeze. Gap unresolved after 3 sessions across 3 weeks. Iran closed the Strait of Hormuz for military drills this month. U.S. military flotilla positioned in the Middle East. Trump's 10-day war deadline issued February 20th. COMEX registered silver at all-time low, 88 million ounces. 5 paper claims per ounce. March 1st notice day tomorrow. Silver up 20% in 6 trading days. Partial Iran risk premium already built in. Full war premium not yet priced. 92.75 is the line between consolidation and breakout. $85.93 is the structural floor physical fundamentals defend. 2 scenarios. Both are silver catalysts. A deal gives you a buying dip on a physical floor that does not move because of a Geneva handshake. A breakdown adds the remaining unpriced war premium to a metal that is already physically at its limits. The compressed spring was loaded before Geneva started. Tonight is simply the hand that either holds it down or lets it go. The fundamentals built that floor. Geneva does not move it. Invest with logic, not hype. Protect your capital. Respect the plumbing as much as you respect the chart. Drop OG John AG or just OG in the comments if you're watching tonight's session. That is how I know who is actually running the data and who is just watching the headlines.